Hi everybody. Today, as you can see here, borrowers with high credit scores penalized under new federal mortgage fee plan. Now, this is going to affect you if you have a house or if you don't have a house just yet but plan on getting one. So stick around so you can see more about what that all entails. All of this is going to be in effect on May 1st, by the way. So you need to hear this before that happens. So stick around to the end and you'll hear more about this, as well as at the end I'll share with you guys what it is that I think about this and how I believe this is going to affect you guys in totality. So stick around to the end and we'll get into that. If you're new here and you like to hear about things regarding personal finance, business credit options, and things like that, then make sure you subscribe to the channel, turn on notifications, and hit the thumbs up so YouTube can share this video with more people that need to hear this information, especially before May 1st, 2023. Because this is going to be affecting you guys on that date and thereafter. So let's go ahead and get further into the information so that you can know how this is going to necessarily affect you guys. So let's dive a little bit deeper here, okay? So this is going to be a tax on you guys with good credit scores, essentially. So this is something that is going to affect people with good and bad credit, but those of you guys with good credit are going to be more surprised that this is happening. And I'm going to just go ahead and tell you up front that this is kind of like a Robin Hood effect of what's going to be going on, right? So let's go ahead and dive deeper. So mortgage borrowers, I can't even talk. Mortgage borrowers with good credit may face higher costs under a new scheme from Federal Mortgage Associations, Fannie Mae and Freddie Mac. The firms have released a new loan level price adjustment, the LLPA matrix, for loans sold to them after May 1st, 2023. And majority of mortgage loans are sold to them, so this is going to affect pretty much everybody. Under the new matrix, borrowers with high credit scores will face higher mortgage fees than before, and those with lower credit scores will face lower fees. So simply put, right there, you can see what I mean about the Robin Hood effect. The people with good credit scores that have done the work to get good credit scores, or maybe you just always had a good credit score, you will now not necessarily benefit from that. You will still benefit from it, but there are going to be some costs to you having a good credit score. And if you have a lower credit score, meaning, maybe you're a person that hasn't done the work and has been avoiding working on your credit, and that's where it's at. But maybe you're also one of those people who just came on hard times. You had a bad situation. Maybe you lost your job at some point and you weren't able to pay your bills, and then your credit got to a bad space. This is something that will actually help you save some upfront money, and we'll talk about what that is in just a minute. So this is essentially what this is doing, but of course we need to know some more details on how this is necessarily going to work. And just based off of your upfront perception of what I've already read to you, please go down to the comments and tell me what you think about this. Do you think this is something that's good or bad? You just let me know what your thoughts are about them, taking extra fees out on people who have good credit and giving discounts on fees to those that have bad credit as a result of what they're doing to try to help some of the people that have lower credit scores be able to afford being able to get a home. Let me know down in the comments. But anyway, so based off what they're saying, here is an example of how this will affect some people. So the fee increase is unlikely to lead to a significantly higher monthly mortgage payments, but most borrowers, for instance, someone with a $400,000 loan and a 6% interest rate. And when I looked up the average interest rate, is actually on a 30-year mortgage closer to like 7%. So, and you know that they already said that they will be increasing interest rates over the next few months during the year. And I don't think there's a definite time on how long they're going to be increasing interest rates. So this can definitely be more than what we see here today. But at a 6% mortgage rate, it will be an extra $40 a month. Now, of course, that's not a whole lot of money. It's $40 a month. If you look at that, that's $480 a year. And if you look at it, over a 30-year mortgage and how much you would actually pay over that time frame, you're actually looking at about $14,400 that you would be paying for the life of your loan. So that's an extra $14,000, that you would have to pay as a cost of having good credit. So based off of that, let's get a few more details on how this is actually going to work. So under the new rules, high credit borrowers with scores ranging from 680 to above 780 will see a spike in the mortgage costs, with applicants who place 15 to 20% down payment experiencing the biggest increase in fees. So the higher your credit score and the more money that you put down, the more of a increase in fees you could possibly see from that. So under the revised LLPA pricing structure, home buyer with a 740 FICO credit score and a 15-28% down payment will face a 1% surcharge, which is an increase of about 0.750%, which is up from 0.250%, which is about a 500 basis point increase. So basically, that is going to be the amount, the percentage or the rate that you're going to see an increase at from you having a higher credit score and putting down more money on your home, which of course putting down more money on your home is supposed to save you on how much you actually, end up taking out in the loan, save you in interest over the life of the loan because you took out less money and all of that good stuff, as well as, not having mortgage insurance, depending on the type of loan that you have. But meanwhile, borrowers with a credit score of 679 or lower will have their fees slashed, as they say here, resulting in more favorable mortgage rates. For example, a buyer with a 620 FICO score with a down payment of 5% or less gets a 1.75% fee discount. So a decrease from the old rate of 3.5%. So, that is basically saying that you're going to save money on upfront costs. So let's take a look at that. The effective penalty for having a credit score under 680 is now smaller than it was. Now pay attention to this. It still costs more to have a lower score. So we're going to pay attention to that when we talk about how this is going to affect you guys, from my opinion, once we get done with this part. But for instance, if you have a score of 659 and you borrow 75% of the home's value, you'll pay a fee equal to 1.5% of the loan. More specifically, your balance, whereas you'd pay no fee if you had a 780 plus credit score. So in that 75% of the home's value, so that means that you're putting down like a 25% down payment or something like that. So, but before these changes, you would have paid 2.75% on a hypothetical $300,000 home loan. That's a difference of about $3,750 in closing costs. So basically, because of this rate increase that you would have paid before for having bad credit, it's pretty much a 1.25% increase in fee that you would have paid for having bad credit, and it would have cost you an extra $3,700 in closing costs. So now you would not have to pay that. So that makes it a little bit easier for you to get a home up front, and they're subsidizing that or making that possible because they're taking money from those who have a higher credit score. And essentially over the 30 years time of the mortgage, they are paying more because of that $14,000 than what you're getting. But because they're taking more from you, I guess they can spread that out amongst more people. So now looking at that, how did this really affect you? How does this really affect everybody in all parts? And again, tell me how you feel about all of this down in the comments, and please be nice so I don't have to block you from the channel completely. So make sure that you are playing nice down in the comments. Give your constructive feedback, not your destructive feedback and don't attack anybody who has a lower credit score, because you know this channel is to help people who do have lower credit scores. So some of you guys do have higher credit scores, but this is not the place for you to go back and forth with somebody and attack somebody because of this. Of course, I do know that this affects those with good credit in a negative way, and I do feel as though they shouldn't really be taking money from people who have done the work and who have increased their credit scores to help out those that have a lower credit scores, because I'm a firm believer in whether you're trying to increase how much you earn or you're trying to increase how much your credit score is, you definitely need to do the work to show yourself approved and show that you are really dedicated to being in a better place, because when you do that, that's going to help you to stay at a better place versus, having everything wiped away for you in one sweep, and then you still have the same mindset and you end up in the same position that you were in before. So I definitely believe in doing the work. So I definitely believe that everybody who does the work should be rewarded for that. Now, I do think that it is still great that it does open up the door for more people. I don't necessarily know how much overall is still going to benefit those with lower credit scores, because even though they're saving you on the upfront closing costs that you would have to pay, because you have a lower credit score, your rate is still, higher than what it would be had you had a better credit score. So still, it would have benefited you overall to have a better credit score going into this. And if you have too high of a credit score, though, of course, then that means that you're going to still have to pay some type of fee, and especially, like I said, that $14,000 over the life of a 30-year mortgage. But of course, if you end up getting a mortgage and you have a higher credit score and you pay it off sooner than that 30 years, you paid off in 15 years, then you have a benefit in that, because that will cut down on the cost, because you're cutting down on the amount of time that you would actually be paying that loan back. So you won't see it as much. And then that, of course, kind of helps, but it's still, of course, I know it's going to be a negative thing and looked at as a bad thing, because you're paying extra money for doing all of the right things. But in all honesty, when it comes to credit and the way that whole system has been set up, when you do good things like pay off a loan, it drops your credit score. When you do good things like pay off a collection account, it drops your credit score. When you do good things like pay off a charge off, it drops your credit score. So the system is already set up in ways that when you do good things, it doesn't necessarily benefit you. So this isn't too far from what we're used to seeing. It's just a different version of it, I would say, that's more so affecting people that's actually getting something after doing the work with their credit and taking the right steps with their credit. So overall, this is something that is costly to those with good credit. This is something that can help those with bad credit in a way, but I think that they could have went a whole different route if they wanted to try to help people to be able to help those disenfranchised people, those people that are minorities, who are statistically the ones that usually end up not being able to get mortgages, or don't know how to go about trying to get a mortgage, and don't even think that they qualify to get a mortgage. So they wanted to try to help according to what they say, and this was not the best way to do it. You shouldn't have other consumers pay the cost for that. They should have footed the bill. They should have done something to make sure that they just implemented new rules that could actually help them without it costing other people. That is something that they could have done, but of course they didn't do that. But of course, I'm not in government. I can't make anything happen. So I'm just giving you my 2 cents on what I think that they should have done. But, tell me what you guys think down in the comments. If you enjoyed this video, give it a thumbs up. And if you want to get more information like this, subscribe to the channel. Turn on notifications so you'll be notified of any time I drop new videos just like this one.